ಅಪ್ಲೋಡ್ ಕರವೇನು ತಿರುಗಿ ನೋಡಿ ಆ ರೀತಿ Good afternoon. We start now. Last Sunday, recorded the lowest attendance online session. And I requested to answer this question. In fact, we did question number 6 is the first part. This is an additional part. I requested you all to do this. Check question number 6 of the previous presentation, the answer, which is the first part of it. Many have missed the lecture, but I assume that it was recorded at least. We had time to go through, watch that video. Question number 6, right? Was it 6? Yes, it is. Regency PLC has invested in two stocks, Alpha and Beta, which have the following returns. Calculate the expected return, variance, and standard deviation of the portfolio. This had only two assets. Therefore, if I remember correct, we calculated using the formula and the other method both. Check your answer. We used both methods. Those who have the answer. Both, right? I can't, I'm not seeing the faces on that date. I don't know who were there last week. Who were there in the class? Both answers are there. Only 30 or students. Last week. You asked. Yeah. Anyone was. Just connections only. Answer. Let me take the answer. By the way, the spreadsheet is also available. Those who don't have the answer, at least open the spreadsheet. Download spreadsheet 6.6. Week 7. Lecture note 4th Jan 26. Available, right? Yes. Check 6.6. Economy state, recession and boom, probability 50-50, and alpha's return, as per the question, 20% minus, 70% return plus, and beta's return 30 and 10. But additionally, we had the portfolio weight. 50% of the wealth was invested in alpha, 50% of the wealth was invested in beta. So that was the only additional information we had compared to all other previous questions we did the previous week. Portfolio weight was given. Right now, step one, check the answer. We calculated the expected return of alpha, which is 25%. Expected return of beta, which is 20%. Answer. It's not on the board. It's check your spreadsheet. 25 and 20. Then I calculated the variance and standard deviation of alpha following normal steps. The probability of the economic state 50-50. I have not still taken the weight of the portfolio. I have not considered. So the return of A is 20 and 70. Check your answer. The return of alpha is 20 minus and 70. Expected return as calculated above in the working 25% for boom and recession both, since that's the expected return of alpha. Then the deviation we have squared deviation power 2 and squared deviation into the probability of economic state is the last column, which is the standard deviation. So the variance is 20.25. The square root of 20.25% is 45%. Alpha's standard deviation. Right. Ignore. Now many have missed this lesson. So ignore the other column 22.5, 50% of the weight, ignore that. Then bottom you have the variance and the standard deviation of beta. Same steps. The only difference is beta's return is available 30 and 10. Then the beta's expected return is 20 as calculated above. Again, the deviation was taken, squared deviation, then squared deviation into the probability economic state. Total is variance, standard deviation 10%. Alpha as a separate investment, the standard deviation is 45%. Beta, independent investment, the standard deviation is 10%. Now, in order to calculate the portfolio standard deviation, we can't take, the investment was how much? 50% each. We can't take 50% of 45, 50% of 10 cannot be taken. That was the principle I explained last week. You can't take the portfolio's standard deviation in that manner. So now see the last column, column J. Was it column J? Yes, sir. 22.5 is 50% of 45 because we have invested only 50% of our wealth in alpha. Then 50% of 10 is 5%. Both together 27.5. In red color, I have indicated incorrect. So you can't calculate the standard deviation in this manner. So don't take 50% of individual ST because you talk about a portfolio. Therefore, you can't take the individual standard deviation and the weight of the investment you can't take because you need to discuss the entire portfolio together. So what steps then we should follow? The correct method is given bottom in the, after the incorrect ST. Again in red color, therefore, the correct method is you need first step now, you need the portfolio's ER. Now we had earlier two ERs, alpha's ER, beta's ER. You don't need individual ERs anymore because you have a portfolio. Therefore, you need the portfolio's ER. How to calculate the portfolio ER? We have calculated individual ER earlier. Alpha CR as 25%, beta CR as 20. 50% of each. Why? Well, 50% was invested in alpha, 50% invested in beta. So 50% of ER should be taken separately, which is 12.5 and 10%. Those two together is the portfolio's ER, right? So first step is to calculate the portfolio ER. Second step. Now, again, remember to calculate the standard deviation, you need a deviation between two rates. So we have one portfolio ER. Now you need another rate to compare. What is the other rate? The other rate is portfolio return, again, not individual, portfolio's return if recession occurs, which means you need to take alpha and beta both. What is A's normal return? As we know, as per the question, 50% of the 20% is portfolio's return if recession occurs A, because 50% of the wealth was invested. So which is 10% minus. B has 30% here, the question. 50% of the wealth invested, therefore 50. So if recession occurs, the portfolio, the variance would be 50% of 20, 50% of 20, 50% of 30. Those two together, answer 5% plus. Check your answer. Portfolio return if recession occurs. Likewise, portfolio return if boom occurs, 70% into 50%, 10% into 50%, both together 40. Now we have two answers, 5% for recession, 40% for boom. Now calculate the deviation. Probabilities are economic state 50-50. Portfolio return, if it is recession as calculated earlier, 5%. If it is boom, 40%. Expected return of the entire portfolio already calculated as 22.5. Calculate the deviation, which is the difference between the portfolio return if state occurs and the portfolio's return, which is 17.5 plus 17.5 minus. Take the standard deviation, take the squared deviation, then squared deviation into the economy state, 50%. Now the variance, and after the variance, you can get the ST. So these are the steps to follow if it is a portfolio to calculate the ST. Second method was what? Using the formula, the recommended one. Now this has many steps. You need the portfolio ST and you need, as per the economy state, ER. You need the ER of the portfolio. You need the ER of each economy state. But if you can use the formula, which is anyway available for the exam. Now see the second method using the formula. The formula will anyway be given. But I told you all last week, those who were there in the class, the formula can only be used in one condition. What is the condition? Those who were there in the class? Now, students, many have missed that lesson. At least now it's a continuation of last week's class today. It seems you have not even gone through the recording, those who have missed. Now, how to continue the rest of the presentation? What is the condition I told? If you have only two assets in the portfolio only, you can use the formula. If you have more than two assets, you can't use the formula. Then you have to follow the procedure that we followed now. First method. If you have more than 2 assets in the portfolio, follow the method that we did now, or the last week's method. If you have only 2 assets, then follow the formula. Now, formula, simple A is investment alpha, which is 50%. Simple B is, or not simple B, 1 minus A is again 50%, 50% of the wealth. But in order to use the formula, you have to calculate the covariance between two. That is the additional information that you require to use the formula. The covariance between alpha and beta, which is also given the first step, 4.5 minus covariance is given. Covariance is 2 deviations multiplied together. We studied this earlier, covariance 4.5. Right, now using 4.5% minus, see, I have used the formula. Check the last one. I have used absolute figures and the percentages both. Let's check the percentages. Second answer. Simple A, which is 0.5 power 2. There are 3 sections in the formula, those who remember. First part, simple A, which is the weight of first asset. Weight of first asset is 50%. 0.5 power 2. 0.5 power 2 into the first asset's variance. Check A's variance in the first calculation on top. A's variance is what? Individually, 20.25. Check the first part. Individual variance of A is 20.25. Right. So 0.5 power 2 into 0.5 power 2 into 20.25, the first part of this formula. Second part, 1 minus simple A, which is again 0.5 power 2 into the variance of B alpha, which is 1%. And the last part of the formula is 2 into simple A into 1 minus A, which is 0.5 each, into the covariance 4.5. That's the last part. So all 3 together, the standard deviation of the portfolio, again, we have arrived 17.5. Same answer. Formula is easier than calculating the ER of the entire portfolio and calculating the ER of each economic state. Formula is easier. So always remember to use the formula if you have 2 assets in your portfolio. But if you have more than 2, you can't use basically, because we have only 2 definitions, A, 1 minus A. We don't have the third letter in the formula. We have only 2 letters. Right. So this was done the other day, which is extra question number 1, which is the presentation 6.6, same question. But extra question number 1 has an additional part. That part I requested you all to do alone as a homework. Suppose the same information here. Suppose we put 2 over 11, which is 2 out of 11, approximately 18%. 2 divided by 11 is 18%, right? 2 divided by 11. Exactly. How much? 18.18. So rounded 18%. So we have invested 18% in alpha, the rest 82% in beta. Earlier it was 50. Now, assuming this was the investment, calculate the portfolio's variance and the rest. Requested you all to do as but if you have not done it now, do quickly. Do not use 80% and 82 in your question, in your answer. Do not use 0.18 and 0.82 because you will not get the desired answer here. Use 2 over here. Then you will get the correct answer. 2 over here. Use 2 over here. Any method can be used because we have only 2 S in the portfolio, either the formula or the other one. Any can be used. Recommend to use the formula because we have the formula details already. The covariance is available. Yeah, quickly you can use the formula. The covariance is not going to change. Will there be a change? No, no change in the covariance. Therefore, you can use the same covariance details. We are going to use the formula. The variance of the individual asset can be used as this. 20.25 and 1% variance. Those are two figures. So those figures can be used as it is. The only difference is your portfolio investment is different now. Not 50-50. It's going to be 2 over 11 and 9 over 11. That's all. A and 1 minus A. Simple A is 2 over 11. 1 minus A is 9 over 11. Extra question 1. Anyone? Did anyone do ST or variance? I have just copied 6.6 individual asset calculation, independent asset calculation to a new spreadsheet. The variance of alpha and the variance and the standard deviation of beta. This is from 6.6. Did anyone use the formula and arrive an answer? Variance and the standard deviation. These are the details from the previous question. It use the information with the new portfolio weight, not 2/11, 9/11. That's all. The covariance and the standard, the variance are the same. From the previous question, you can get those values. So let me copy the covariance also from the previous question, the same covariance of the previous question. Covariance part, this one. Same covariance of 4.5. No change to the variance of alpha, no change to the variance of beta, no change to the covariance. Those figures will be the same. So apply, just an application of the formula. What is the answer? How much is variance? Is. There's no calculation. Variance will be 0. When the variance is 0, standard deviation is 0. Why it is 0? Okay, to understand that, all must have used the formula now. Let's use the other method to understand why it is 0. Right. What is the other method? You need the ER of the portfolio. Calculate the ER of the portfolio. ER of the portfolio using the new weight. ER of the portfolio. Two assets, alpha and beta. Two ERs, individual ERs already calculated earlier. Two ERs are 25 and 20. 25 and 20. From the previous calculation in 25% alpha and beta 20%. The weight, now the weight is different, new weight. Do not use 18%, as I said earlier, use 2/11. And show that as a percentage because it is not exactly 18, then it has a few decimals. So it will be 18.818. And the weight of beta, 9/11 as a percentage. The weight. Portfolio ER, ER, portfolio ER. (25% into 18.18). And the total, the portfolio is 20.91. What was the next step? If recession occurs, how much is the portfolio's ER? Calculate if what is the other boom occurs, how much is the portfolio's return? For those two ER, the same way that we did in the previous question. This is the previous question. See, if recession occurs, see A, B added together 5% and 40%. But it was 50-50. Now the new weight. If recession occurs, how much would be the return? These figures are wrong. Huh? Don't use the same figure. This is what we used earlier. We need to change these figures. What are the new figures? If recession occurs, alpha's return is just 20% minus. As per the question, remember, 20% minus. But if recession occurs, now the weight is different. How much is our new weight for alpha? 2/11. Formula 20% minus multiplied by 20% minus multiplied by 2/11. Check the cell. 20% minus into 2/11. If boom occurs, same 70% return into 2/11. 12.7. 2 decimals, 3.64, 12.73. Beta. Beta's return from the question is how much? 30 and 10. Beta's return is 30 and 10, individual return. 30% into beta's weight. 30% into 9/11. 10% into 9/11. 24.55, 8.18. These two together, 3.64 plus 24.55, 3.64 is minus, therefore 20.91, 20.91. Now, what you all can see. The return is equal. If recession occurs, return is 20.91. Even if boom occurs, the return is 20.91, which means no deviation. Same answer. No change, but earlier we had a change. Therefore, there was a variance. Therefore, we had a standard deviation in the previous one. Now, these two are equal. No further calculations required. That's the reason why you got zero variance using the formula. Reason? In the if recession occurs, you can expect 20.91 from the entire portfolio. If boom occurs, here the same. So no deviation. Therefore, when you see these two as equal, no further calculations required. Your variance must be zero. Your SP must be zero. That is what you got using the formula. So let me show, for those who couldn't use the formula and reach zero variance, I'll show the formula. Formula. Let me copy the formula. This is the right. Define simple A. Alpha's weight 2/11. Second, 1 minus A, which is beta's weight 9/11. Now use the formula. 1 minus A is 9/11. First part, A power 2, A power 2, 2/11 power 2 into the variance of A. Formula, variance of A power 2, variance of A. What is the variance of A? Variance of A is, first calculation, check. 20.25? No, 20.25. Variance of A, 20.25. First part of your formula. 20.25 must be on top. See, 20.25 alpha's variance. Second part of the formula. 1 minus A power 2. 1 minus A is 9/11 power 2 into the variance of B, 1%. Yes, 1%. 1% is on top. See, check your calculation. See, 1% beta variance. Last part. Two into A simple A, which is 2 over 11, into 1 minus A, which is 9 over 11, into the covariance between A and B. Covariance 4.5, same 4.5 minus. See, its covariance is here. We calculated earlier for covariance for 6.6 answer. 4.5 minus. Now calculate these three and add all three. First part, 2 over 11 power 2 into 20.25%. Answer as a percentage, 0.669. Second part, 9 over 11 power 2 into 1%. 9 over 11 power 2. And the last, 2 into 2 over 11 into 9 over 11 into minus 4.5%. Put a bracket here. Add all three. First one, second, and the third. Answer is 0. As expected. SD is 0. Why SD is 0? This was the reason. As for each economic state, the return is same. 20.2191 and 20.91, which means no variations. The same amount will be received. If you are an investor of these two, you will get 20.91, whether it's a recession or boom. So no further points, which means no further points around the mean, only one item. If you have only one return, which is a static or which is a standard value, no variance. These three at total is standard deviation of the portfolio is 0, which means even the variance is 0. Shall we quickly calculate the same variance and SD since we have the recession return and the boom return? Shall we use the other steps? The method we for 3 asset portfolio. So let's use that also. Now, if you have to use the other method, what figures should be compared? Portfolio ER versus respective to ER. So now see, the figures are equal, which means the deviation is 0. When the deviation is 0, square deviation is also 0. Square deviation is 0 means square deviation into the probability of the economy state again 0. So 0, 0, 0, all the places. No need to calculate. The variance will be 0. See, you need to compare 20.91 with 20.91 of the portfolio ER. Deviation is 0. No need to show. When the deviation is 0, all other answers are 0. Right. And the last question is 3 asset portfolio. Extra question number 2. Compass invested 50% in stock A and 25% each in stock B and C. State of economy, boom and bust only, 60 and 40 and 60. The respective returns are given. Portfolio weight, 50, 25, 25. Formula cannot be used. Use the steps. Calculate the portfolio ER, number 1. Then the deviation. What are the deviations? If boom occurs, what is the portfolio's ER? Compare the portfolio ER with boom ER. 1 deviation. Second, calculate the bust ER. Deviation is the portfolio deviation minus bust ER. Then square deviation and the rest. Please do. This question is available in the LMS, week number 7. ER of A, 8.8, ER of B, 8.4, ER of C, 8. Weight 50 to asset A, 25 each asset B and C. Therefore, the portfolio ER (8.5). 1% of the deviation, which is 8.5. You need two more rates to compare, two more percentages to compare with this ER. What are those two? If boom occurs, what is the ER? If bust occurs, what is the ER? Now, this is the entire portfolio's return. Now, you need the portfolio return if boom occurs. How to do this? Portfolio return, if boom occurs, we have three. Asset A. What is the percentage? 50% to asset A. If boom occurs, what is the return of asset A on top? 10%. Asset A's return is 10%. Into what percentage? Okay, let me write the weight also in front. We all weight is 50% each. For A, 50%. Return is 10% for A into 50% of the wealth. 5% return. Right. If bust occurs, A will give us 8%, wealth 50%, 4%. Right. Let's take B. Asset B. B's weight is how much? 25% each. 25, 25. Right. If boom occurs, A will give us 15%, but the portfolio weight is 25%, 3.75. If bust occurs, B will give us 4%, percentage 25. 1%. Now the last. C. C. Portfolio weight is again 25 each. If boom occurs, C will give us 20%, but 25% of the wealth. If bust occurs, it will be 0% into 25%. Answer is 0. Return of the portfolio. Return of the portfolio, all three together. 5% plus 3.5% plus 5%. What is the total? 13.75. That is if boom occurs. If bust occurs, the return will be less, surely. Yeah, 5%. Now remember the previous one, these two were equal. Therefore, we did not proceed further. No reason to proceed further when these two are equal. But here the values are different, which means there is a variance, which means there is a standard deviation. Return of the portfolio 13.75 if boom occurs. The return of the portfolio, RP for return of the portfolio. If bust occurs, it will only be 5%. Right. What is the deviation? Deviation is the difference between individual return, boom and bust, and 8.5 portfolio's expected return. Deviation. Find the deviation, find the square deviation into the probability, and total is the variance. Portfolio return as calculated. If boom occurs, 13.75. If bust occurs, 5%. Expected return of the portfolio, ERP. ERP was calculated earlier as 8.5. 8.5 is the ERP. Deviation is the difference between these two. Portfolio return minus portfolio expected return, ERP. Squad deviation is into power 2. Squad deviation into the probability. These are the steps of variance. 0.28 into the probability of 40%. And total this, which is the variance. Variance and the last answer is standard deviation. $4.29. So unlike calculating the standard deviation of an individual asset, the difference here is we have compared the deviation. The deviation is between the portfolio return and the expected return of the portfolio. Individual assets is individual return and the expected return. If it is portfolio, portfolio's return versus portfolio's ER. Formula cannot be used since we have three. Make a note on that as well. Formula cannot be used since we have three assets. Okay. Yeah, on the other day I couldn't draw this line when I was doing the lecture. Now it is shown. Remember, I told it's a V-shaped line, which is known as the efficient frontier, and the best point is the last point in terms of the way, which is the best point, where the lowest standard deviation, which is for the standard deviation, is to even to assess the risk. Now these are the combinations in that question. What was the question number? The question was question number was 11, 6.11 question. No. That's it. 6. Yes, correct. 6.11. We had those who have missed the lesson. We had two assets in the portfolio, in the two asset portfolio, but different combinations. Combination 1 to 7. In first combination, 100% of A. The last combination, 100% of B, and in between, different percentage. So for each, we have calculated the standard deviation using the formula. See, using the formula, see. 1 to 7, SB 3.16, 1.17, 0.4, 1.02, again, increasing standard deviation. And from this, the lowest point in terms of the standard deviation is 3. The combination 3, 85% of A and 15% of B in terms of the belt. That was the lowest standard deviation. So these details were plotted in a chart. X-axis is to show the risk, and the y-axis to return. These are the combinations in terms of the standard deviation and the return. One SB is for the x-axis, the return y-axis. And a line was drawn. This line is known as the efficient frontier, where this is the graphical representation of the risk and return combination. So the best is this point, y in terms of the risk, but which will not give you the highest return. Because if you are willing to take the highest risk, the return is very high, say 20% return. See? But that comes with 17.25 standard deviation. But the lowest standard deviation, which is 0.4 at combination 3, the return is 15.75, this point. So you can't accurately calculate the best investment combination using the graphical presentation. Therefore, there is a formula for that also. This is the last question. We did that as well using this formula. Finding the minimum standard deviation for combinations of 12. Now, this is not the best, right? This is the minimum. If the company's risk attitude is to take a risk, then of course the higher returns can be achieved. But if the company's risk appetite is to take the lowest risk, using this formula, you can find the lowest risk combination. That will of course not give you the highest return. So using this formula, variance of B, the variance of B minus covariance of A and B over the variance of A plus variance of B minus 2 into covariance of A and B. We did this as well, no? Spreadsheet, check the spreadsheet. Yes. The covariance of this we must have calculated earlier before the answer. 0.54 minus is the covariance between A and B. Variance of A is 4.98. Variance of B is 0.1%. So apply those that formula, you get answer is 84.62 answer. Check the answer formula. This part is 3.52%. Denominator is 4.616. Divide F152 by F153. You get the best curve. You get the weight of A only. The answer you get here is the weight of A only. 1 minus A is automatically the B's weight. So what is the weight we found? 84.62. If A's weight is 84.62, then the balance 15.38 to B. Now this is very much closer to the graphical presentation's value, 85.50. Combination 3 was 85 to 50. Check the question. $85.50. We got the lowest ST at this rate. So we got the very similar answer using the formula. It is not exactly 85, it should be 84.6. You can get the accurate answer using the formula. So we got the best combination, the weight of 84.62. Now see, using these two percentages, I have done an extra part. I have calculated the ST also. Now, if it is 15 and 85, ST was how much? 0.4 as per our calculation. Now, it is not exactly 85 and 85 and 15. It is 84.62 and 15.38. Using those two figures, I have calculated the ST. ST is not exactly 0.4. It should be less than 0.4. In graphical presentation, it was 0.4. Because in the graphical presentation, we use 85 and 50. For the most accurate one, ST is below 0.4. Right. So those who have missed this lesson, please go through the recording. It's very, very important. Next. Now the balance part of the same presentation. Derivatives. Right. Oh, financial derivatives must have studied for IFRS 9. You can recall the accounting standard, the most difficult accounting standard, right? IFRS 9 or SLFRS 9, financial instrument. What is a derivative? All must have done the accounting standard. Now, the financial management part of the derivatives, I'm not going to study the accounting part here. Okay. In very simple terms, derivatives are also assets. Derivatives are assets whose or those assets performance is based on the performance of their underlying asset, which means the derivative is different to the underlying asset. What are the most common underlying assets which are linked with derivatives? Most common underlying, sorry, any valuable item, say for example, even crude oil or platinum or gold or even commodities, expensive items are the underlying assets. So please remember the derivative is different to the underlying asset. These underlying assets can be, let's say, crude oil. You need to fix the price of a crude oil by having a derivative possible, because you are not sure whether you will be able to get the crude oil in a future date at the same price. So what you should do? Use one of the derivatives to fix this price. Forward contracts, must have studied. Options, you must have studied. Futures, swaps, those are the main four derivatives. Options, futures, forward contracts, and swaps. The point to remember, derivatives are different to underlying assets. The value of your derivative depends on the performance of the underlying assets, which means if you have entered into a derivative with another party, the value of that derivative instruments depends on the performance of this. If this goes up, there will be a change in the derivative value. If this goes down, there will be a change in the derivative value. So the value of the derivative, which is a separate asset, depends on the performance of this. Right. There are certain derivatives are obligations, certain derivatives are rights. Say for example, option. Okay, all must have studied what is option, what is a future, what is a forward contract, no? What is a swap? Those four, did you all study the definition? You must have. Okay, these are the four items. Options, forwards, or usually options, futures, forwards, and swaps. Those are the four main derivative instruments. What is an option? For those who have not studied before, I'll give you an example of an option. Counting part, I'm sure must have studied. This IFRS 9 included intangibles. Sure. What is the subject? Financial reporting or advanced corporate reporting? Corporate reporting. So the double entries, I'm sure you must have studied. So then, without knowing what is a derivative, you study what is called the double entries. What is an option? Okay, let me give you an example. Option. By name itself, it is an option, which means, there is a right. If you are a holder of an option, you have a right to exercise this. But remember, it is not an obligation. Which means it is your decision to exercise this right or not to exercise. So, if you are a holder, you have a edge or you have a right over the other party either to exercise or not to exercise. That depends on the market rates. Right. Now assume a very simple example of an option. There is an option which is a derivative instrument. Underlying asset is the land. Underlying assets can be any, as said earlier, it can be a valuable item. So the underlying asset here is a land, a bare land, undeveloped land, owned by a farmer. There is a developer, land developer. Let's take one of the local examples, prime lands. A developer. has an interest over this land owned by the farmer. The value of this land is assumed 1 million. Undeveloped land means prime lands business is to develop lands and sell, construct residential properties and sell, business properties and sell. So since this is an undeveloped land, you can't develop it without an approval. The land, in order to develop, an approval must be taken from the authorities. Now, obtaining the authority, farmer has no control over this. Even the developer has no control over it. Obtaining the approval. It is slow, it is with the government or the municipal council. Now, this approval takes time, and therefore, since prime land has an interest over the land, prime land enters into an option contract with the farmer to fix this deal, which means the farmer will not be able to sell this land to another person. Now, which is an option contract with the farmer. Of course, the farmer will not agree for free. There is a price for this option. There is a price for the land. There is a price for the underlying asset. Sorry, price for the derivative instrument. Of course, there is a price for the underlying asset. The price of the derivative is compared to the underlying asset is always very less. Negligible value compared to the underlying assets. Now assume prime land has paid 10,000 for this option. It is a contract. What is the contract? They have entered into an agreement to buy this land. Of course, there is a period. Assume today's date is January 25, today's date. And this option is valid for 6 months, 30th June 2021. During that period, the farmer is not eligible to sell this land to any person. Binding contract. For that only, a non-refundable value of 10,000 was paid. Why did the developer has paid this? Because the developer is not sure of getting the planning approval. If the planning approval is only available, they can construct as per their desire residential property or whatever. The development can only be done if the approval is obtained. So there is an uncertainty. But that was the reason why they have not paid 1 million and purchased this. Now, what if the approval is not granted by the municipal council? Developer is not going to buy this. 10,000 is not refundable. It's going to be an income of the farm. Of course, after the 30th, farmer will be able to sell it to another farm. 10,000 is cost to the company. If the approval is granted, then what is the question? The developer can immediately pay 1 million. Of course, this is an additional pay and buy this land. What is the benefit? Once the approval is granted, usually the land value is increased. So the land value after the approval, assume it's 1.5 million. So there is an intrinsic value of 500,000 for an investment of how much? Only 10,000, not 1 million. What was our initial investment for this option? Only 10,000. What was the intrinsic value gain? 500,000. So these are the features of an option or a derivative. Your investment is very little and your return is very high return. Now, remember I told option is it's not an obligation, but it is a right. Right of whom? The developer. Right of exercising is with the developer. If he has not received this permit, he can not exercise this, which is not obliged. They are not obliged to do it. It is not an obligation for them to exercise this. If they are not received, they can allow the option to lapse after this date. That's fine. Did all understand? Now, this instrument is tradable. Assume there is another developer, developer 2, ICC, has an interest over the same land. what can the prime lands do now? They can sell this option to ICC for, say, for example, 20,000 rupees. Now the hold of the option is not prime lands. The new hold is ICC. ICC will be dealing with the farm. What was the benefit to the prime lands? They got an extra 10,000 for nothing. They sold it. Now the two parties are mixed. Even if they don't want, they can sell it to another party, home lands, 30,000. Still, there is unnegotiable instruments or a tradable instrument. Right. See, this page says certain derivatives are contracts that give the right and sometimes obligation. Now in this derivative, you have a right, no obligation. But if you think of a forward contract with a bank, you have agreed to buy certain amount of dollars in a future date. You have an obligation there. Whether the rate is X or Y, you have to buy. So you have an obligation also there. In certain contracts, you have a right. In certain contracts, you have an obligation to buy or sell a quantity of the underlying asset, buying or sell, or benefit another way from the price or fall in the value of the underlying asset. Derivative instruments include the following options, forwards, and futures. The option now I have already explained. I think you have a few more notes on the other three as well. This is what I have already explained. An option contract gives one party a right, but not the obligation. Prime land has a right, but not an obligation to perform this. The purchaser of the option, which is the prime lands, can either exercise the right or let it lapse. It's their right. Right. The second item is a forward. Now the difference between an option and a forward is forward has an obligation. Unlike option contracts, forwards commit both parties to complete the deal. So there is an obligation. Earlier, the first party didn't have an obligation. In a forward contract, both have obligations. If you have entered into a forward contract with a bank to buy certain amount of dollars in a later date, they have to sell, you have to buy. So both parties are committed. The definition is given. A forward contract is an agreement between two parties to undertake an exchange at an agreed future date, but the price is agreed today. Say, for example, forward contract interest. You can agree with the bank today, the loan that you are going to take in the future, the interest rate can be agreed today and fix that. So on that future date, the bank should give you the loan and you should take a loan. Agreed rate today. Very common in foreign exchange, you all know. If you are expecting a future remittance in the future, say today is first and you are expecting on the 30th March, 31st March, and you want to fix the rate, you can agree with the bank to fix the rate today, and that rate will be utilized on the 31st March forward contracts. So this is applicable on interest. This is applicable to mainly to exchange rate, also exchange rate and interest rates. Then futures. Forwards, these futures. Very similar to forward contract, where you will be agreeing with another party to deal in the future date. The difference is now a forward is tailor-made. Say you are expecting $558,000 on 31st March. Exclusive value for you, $538,000. So tailor-made, the forwards are established as per the requirement of the client. Tailor-made figures and tailor-made dates. You are expecting it on 31st March, and the value is as per as per your sales income. Those are forwards. But if it is a future, very similar, but standardized values, standardized date. That's the difference. You can't have a tailor-made future contract. Contract values are defined. The contract periods are defined. So those are not tailor-made ones. Those are standard values and standard periods, and therefore those can be exchanged, which means you can sell and buy those from another party. Traded on a regulated exchange. Those are tradable instruments there. The only difference is fixed standardized transaction, not tailor-made values or dates. The last, very common, SOPs. What is a SOP? SOP arrangement. Again, must have covered in IFRS 9. This is for foreign currencies and mainly for interest rates also applicable to both. Foreign currencies, SOP means between two parties. Now, there was a very popular SOP arrangement between the Sri Lankan government and the Chinese government during the crisis. Remember, 6 billion yuan. Very basic transaction. Mean you get, now assume during that period, 6 billion or 2 billion yuan we got from them, and we gave them LTR value to them on that day. And the SOP arrangement is for a particular period. End of the period, we have to give them back the borrowed money in again yuan and collect our money. SOP between two parties, their currency with our currency. But the interesting part is not the currency one, but the interest rate. Interest rates, how to stop interest rates. There are two types of interest rates. One is fixed interest rate loans, the other one is floating. Now, assume you have taken a fixed interest loan, fixed rate interest bank loan from the bank, fixed interest rate. And there is another party who has obtained a floating rate. You have taken a fixed, another party has taken a floating. Now you have taken it, but you want a floating now. But you have taken a fixed. You, as per your business model, the floating is more profitable to you than a fixed. But for the other party now, it's the opposite. They want now fixed, but they also have taken a floating. SOP these two. Did you all do a computation for this? No? Let me show you all an example. We don't have it here, right? I'll take an example. Right, this is from a different university. That's fine. Just to understand what is, how it works. Read this just to understand how it works. This is how interest rate SOP works. Those who are not studied before. A and B want to borrow 150 million pounds for 8 years. In order to have a SOP arrangement, your capital must be equal. Your loan value must be equal to the other party's loan value. Otherwise, you can't SOP this. So now both parties want to borrow the same amount, 150 million pounds for 8 years. The tenor must also be equal. A would like to borrow on a fixed rate. A's desire is fixed. Take your notes. A's desire is fixed. Because that because this would better match its asset position. B's desire is B prefers floating. A prefers fixed. B prefers floating. Now these are the rates available to A and B, the quotes given by their banks. Following quotations they have received. A can borrow fixed 10%, floating LIBOR plus 2%. B can borrow 8 fixed, LIBOR plus 1% float. Their respective banks have given them a quotation. A's desire is fixed, B's desire is floating. Remember those two. And the rates also you need to remember. To move to the next slide, remember these rates or take down the rates. A can borrow at 10, B can borrow at 8, floating, LIBOR plus 2, LIBOR plus 1. Okay. And take the note of their respective desire also. A wants fixed, B wants floating. Right. Now, now the A's desire is fixed, but they have entered into a contract with the bank to borrow the opposite. That's part of the soft arrangement. A's desire is, remember, fixed. Fixed, no? A's desire was fixed. But A has borrowed money using their floating rate, which is against the desire. That's a part of the soft arrangement. A's desire is fixed, but A has taken a floating loan from A's bank. So then what is the rate of the previous slide? Floating, LIBOR plus 2. LIBOR plus 2%, A's cost. Now, A has to pay LIBOR plus 2% to A's bank. A borrows floating rate fund paying LIBOR plus 2, and B borrows against the desire. B's desire was floating. B has borrowed fixed. What is B's fixed rate? 8%. Correct? 8%. So the first, both parties have taken a loan against their desire. Right. Now, that is the transaction with the bank. First point is the transaction with the bank. Second is the swap arrangement. Swap arrangement, nothing to do with the bank. It is with A and B. Now, what are the conditions of the arrangement? These are the conditions. Point 3. One way of achieving this is to arrange the swap, but this means to minimize your cost and to make it and to earn a benefit from the swap arrangement. One way of achieving this is to arrange the swap on the following basis. These are the conditions of the swap. A pays B. What was A's desire? Fixed. Fixed. Therefore, A has agreed to pay B a fixed interest rate of 9.5. Now, these rates are not there in the bank quotation. These are between A and B. A has agreed to pay B a fixed rate of 9.5. B's desire was what? To pay always floating. Correct? As per the paragraph floating. Therefore, B has agreed to pay A LIBOR plus 2. These are floating. These are the conditions of the swap arrangement. Right. Please take down these two also. A has agreed to pay B 9.5 fixed. B has agreed to pay A LIBOR plus 2. Okay, now next, think of A's position now. A's position. A has taken a loan from the bank, floating, outflow LIBOR plus 2. Agreed. There will be an outflow of LIBOR plus 2. B has agreed to pay A LIBOR plus 2, isn't it? As per the swap. So A receives LIBOR plus 2. What is the net effect? 0. LIBOR is always equal to both parties, which is the London is a bank of a rate, which is equal to both parties. UK company, no? Even any other company, the LIBOR is same. Get the same LIBOR rate. So the net impact here is 0. A pays B how much? Fixed 9.5, right? As per the swap arrangement, 9.5. The last one. So the net impact is what? Only the last one. Net payment is as per their desire. They wanted to have a fixed one, 9.5. Right? Now, what is the benefit? If B had taken a loan from the bank for a fixed, how much they would have paid to the bank? Check the first line. Huh? Check the first table. 10% fixed. They have to pay 10% to the bank. Now, what is the status? They have to pay only 9.5. A benefit of 0.5. So that's the benefit people. 0.5 of 150 million pounds, a considerable amount. Loan value was 150 million, a considerable interest rate. The savings, you have to compare what if it was. If they have taken a loan from the bank, they would have paid 10% fees. But now they are paying 9.5. Benefit of 0.5. A is first. Now B's position. B pays to the bank. Is it refund to the bank? Fixed 8%. B receives fixed 9.5 from A as per the swap. So there is a net benefit of plus 2 1.5. The benefit. Agree? Right. B has agreed to pay A LIBOR plus 2. B has agreed to pay A LIBOR plus 2. Now there is a 1.5 benefit here, and B is paying LIBOR plus 2 to A. Right? So what is the net cost? 0.5. Outflow is more than the benefit here, 0.5. Out. Net payment is 0.5. Okay, all good. Right. If now, what type of a net fee is this? This is a floating. If P had taken a floating from the bank, what is the rate? First table, LIBOR plus 1%. They would have paid extra 0.5. They are now paying only 0.5. Same benefit to party B also. In a swap arrangement, you can't have different benefits to parties. A's benefit is always equal to the B's benefit. Gain 0.5 of 150 million. Please remember, this is not the benefit. Huh? The bottom line is not the benefit. This is an outflow. You have to compare this with if P had taken a loan from bank, what is the rate? LIBOR plus 1%. Right? LIBOR plus 1%, but there is an outflow of 0.5. The difference between 1% and 0.5 is the benefit, not this one. If they had taken a loan, then the answer is LIBOR plus 1. They have to pay. Now, what are they paying? LIBOR plus 0.5. So there is a saving of 0.5. This is not in your syllabus, by the way. You just need to know what is a swap, what is a future, forward, then That's all in this presentation. By the way, there was I have shared this news the day we met last time here. The continuous assessment date will be on the 18th. So please get ready, 20 marks. There was a request from one or two students to see the possibility of changing the portfolio. So the continuous assessment type, which I'm sorry, I told that student we can't change this because these are the continuous assessments agreed with the university. Though your module spec says 2 presentations. Now, even for the last time, spoken to the director and even the registrar and agreed to have a different portfolio. There is a different continuous assessment. The reason was a batch size of 100 plus, it's not going to be possible for 2 presentations. Even now I'm thinking how to take one even presentation. A group of 8 into 160 students means 20 groups, 30 minutes each group, 10 hours, 2.5 sessions. How to allocate 2.5 sessions out of 15 sessions for a one presentation. If it is 2, 5 sessions for presentations only out of 15. No time to learn. So it's not practical. Therefore, for the previous batch also, we got the approval to not to have 2 presentations and to have 1 presentation with a quiz so that you can save the time. So we can't change the quiz. It will be a quiz, and the excuse given by one of the students was we are not ready for the quiz or we have no time for a quiz. But please remember, after the quiz, within next 5 weeks time, you have the exam. So the exam, you can't give the same excuse, right? You have to face the exam, and it is unseen exam. No, it's paper or closed book. So quiz just before 5 weeks, you get it at least. So at least you study for the quiz, and that knowledge can be used for the exam at least. So there's no difference between the quiz and therefore the exam. So I told that student also, sorry, we can't change and you have to get ready. And a few rules that I told last time. Now this is presentation number 7th is a very small one. We can do it today itself. So it will be from 7 presentations. And of course, we have 2 more weeks. 17th is not the next week. It's next. Yeah, it's next week. So you get questions from the next one as well. MCQs. But batch size altogether 160. So it will be divided into 3 sessions. I will give you the time. Say, for example, 2 to 3, 1 set, 50 students from using the lab, and say 3 to 4 and 4 to 5. And say 1 to, you can start the first session 1 to between 1 and 2, then 2 and 3, 3 and 4. If there are students, then 4 and 5. Because the capacity is only 50 computers there. So please make sure not to use, of course, you can't take your phone there. Therefore, please bring your calculator. So don't tell the supervisors there that I don't have a calculator. Therefore, please allow me to take the phone inside. No, they will not allow. Therefore, bring your own calculator because you need the calculator to answer those questions. Mainly calculations. Say I would say 60 to 70% calculations, the balance theory, the questions you get. So the attendance will be taken, though it is an online quiz. So even if you access from home and do your quiz, those marks will be disregarded because the attendance will be taken. Those who are doing within the premises means not anywhere else in the campus, within the IT lab will only be considered. Therefore, please do not even attempt to do the exam elsewhere, do it from elsewhere. the marks will not be considered because the attendance will be taken from each student in front of the attendance on the marks will be indicated. That's point 1, point 2 about the calculator, and point 3. It is not a restricted browser, but there will be staff to supervise. So therefore, please do not use any other browsers other than the LMS, because in the last time there was an issue, and severe penalties now they impose. When you if you use AI or any other browser, I'm sorry, because it's an exam. Therefore, please do not think of artificial intelligence help. You will not get. If you use it, your marks will not be given. So don't get into that issue, that level, because there was an issue in the last batch and they got the penalty. Therefore, no artificial intelligence. Use your knowledge, because still the computer lab has no restricted browser option. So any browser can be used. So that means you still can use the Google AI, but if you use it, you don't get marks. So therefore, please don't use. Do not change the browser from the LMS. Use the LMS only, and please make sure. Many students, I remember last time there was issue. They have not. They have used only the phone to the LMS, and on that day they had an issue to open their LMS on a computer. So therefore, try to open it before in advance. Use a computer, a laptop, and see whether you can open your LMS and the password, especially because password must be saved in the phone only, and you all can't remember the password. Some, certain students couldn't remember the password to open the LMS on a different computer. So those must be followed. Please take a break. Not really. And by the way, those are very basic MCQs. Basic MCQs, right? By the way, now say for example, first hour's question will not be given to the second hour's students. So it will be 4 different databases. Then the questions will be picked from the database, which means your questions are different to your questions also. Right? Sorry? No, shortcuts. Sorry. Very short ones. But now, because you should be able to answer one question within 3 minutes. That's the standard. Because you get, I can't remember whether exactly it was 12 questions or 15 questions. I'll let you know. Please check whether all your members are in the WhatsApp group, your friends. I see it is still less than 160 members, which means certain students are not still there. Now today is the 9th or 8th session. We have only 7 sessions more. And some students are still not there in the WhatsApp group. Yes, today added. 1, 2 numbers added today. No, sorry, it's a change. How many members? 147 still. Batch size is 172, I guess. So still certain members are not in. So I will communicate. I will update you all certain rules which are applicable to the exam before. You can, not the phone. That's all. And your own calculator. Right, please take the break. The size of the question now, for example, you will not get a portfolio standard deviation calculation. You will not get, because you need 30 minutes to do that. So that's what I said. You will never get this type of questions because this is near minimum 30 minutes to do the SD. So you will not get that time. Of course, the intention is to give you all marks. Therefore, the questions will be very easy. What the subject is mathematics. One. I work പിന്നെ ഇവന്റ് റിഫോർമേഴ്സ് ചെയ്യുന്ന സെറ്റ് കഥകൾ පස්තනක කතා කරන්න පොඩ්ගේෂන්ස් පස්සේ ඉන්න ඒජන්ස් පන්තියල්ල තියෙන පළවෙනි කෙනෙක් දාලා ඉවරයි. සූටබල් පය දෙන්න කියලා. එතනට තැනට අප්සෙට් යන්න වෙන්නේ නැහැ. පළවෙනි පැයේ හතර දැන් පැය හතරෙන් කරන්න වෙනවානේ 150 වැඩි නම් පැය හතරෙන් කරන්න වෙනවා. ඒ හතරෙන් කැමති පැයක කෝඩිනේටර් කියලා. එතකොට ඒගොල්ලෝ ඒ කෝඩිනේටර් දැන් හිතන්න පළවෙනි පැයෙම කරලා ඉක්මනට යන්න ඕන නම් 1යි 2යි අතර කරලා යන්න. නැත්නම් අන්තිමකට එන්න අන්තිමක නම් බලන්න. The number of members of the group has gone up to 160. The number of members has gone up to 160. Which means there will be 4 sessions. By the way, respective coordinators, check with your friends if someone has a requirement to do early, so give them a chance, because certain 2 students came in this. I will.
Sending one of the coordinators. There's another request. If you can give another week extension to get ready for the.
You know the university rule. By the 10th of the session, CA marks should be ready. I can, but they are not flexible. Then when are we all going to do the CS2? Another 20 marks component. If you have seen the session plan, I don't know, the session plan is, it says by the 10th week, both CA marks should be ready. I told them I can't do that because the students are not ready. And now the CA exams, it was planned in December, and therefore I had to postpone this. Now again, it's in January. And again, I had to postpone it. Now we'll be doing it just after the CA exam. And the problem is, if I delay it further, then the CA2 will be just before the exam. Then they will not tolerate it at all, because they want the marks, and you need the marks before the exam also, right? So, and they are not going to extend the exam date. If that is the case, yes, then we have time. We can be not delayed. Even now for first years, we had a lot of issues in December, weather issues, but still the exam date, they have not changed. The exam date is the same. Sorry? If so, I'm okay. If they can change the exam date, I'm okay. Surely you can get another week or even 2 or 3. So it's your to talk, up to you all to discuss with them and see whether the exam dates can be extended. I'm not sure. If so, fine, I'll extend. Because then I'm not required by giving by the 10th. No? So if the exam dates, if they are going to extend it, I'm okay. Fine. If there are other coordinators are not there, then I will post it in the group. So if anyone has a requirement to leave early on the 18th for office matters or any other, so please allow them to sit in the first batch. It's from 1 to 2. And if anyone wants to join for the 4th one, then please allow. Then that's up to the coordinator, right? So whatever is done, there must be 50. It should not be less than 50. Otherwise, we will have to have the 5th session. For that, we don't have time. No, it's only 50 into maximum 4 times. We'll be covering 200. We don't have 200 students. 50, 50, 50, and maybe less than 50 in the last session. So 50 must sit on the first group. So all should come on the time and then wait for the second attempt or the wait for the second time slot once the first one is over. Okay, the portfolio management basics. Portfolio management, of course, we did the portfolio standard deviation calculations and the variance calculation, but the theory part of the portfolio management. The relevance of security prices, the expected value, which we have already discussed the calculation part. We are not going to read variance or mean variance criteria. Security mark investment and risk. Portfolio theory, very important. CAPM theory, the capital asset market line, the capital asset pricing model, the assumptions of CAPM. Right, a price of a share. We have studied before. Dividend valuation model, presentation number 2. early part of your syllabus, we calculated the value of a share P0 given the formulas. Presentation number 2. Which means that your workings, it is not there in the presentation. With the business valuation, we did it as extra questions. Value of a share is equal to value of a share is equal to numerator is what? Division divided by what? Sorry. Correct. Precisely dividends of year 1, not D0. Dividends of year 1 over KEOR, cost of equity or return, any letter can be used, minus 2. How to get E1, which is today's dividend into 1 plus G is E1. That's value of a share. But the value of a share, you don't need to value it. If it is a BSAA, we can get it from the share market, which is the best price based on the demand and supply. That's the price of a share at the market, but you also can do a valuation and see whether this price is reasonable. This is the formula. Similarly, we calculated the cost of equity as well in the same presentation when I was doing the business service. AE is equal to, because again have the formula, the notebook. Cost of equity is equal to, remember, dividends of year 1 again over the same other. Now, for you to calculate KE, this must be available. No, now 2 unknown variables, E1 over B0 plus the growth, right? E1 over B0 plus the growth, cost of equity. What is the model name? Dividend valuation model, based on dividends. The second method of estimating the cost of equity is this one. Portfolio theory or CAPM, capital asset pricing model. You must have used this formula also before. The second method of estimating the cost of equity is equal to the CAPM formula. CAPM formula is RF RM minus RF into the risk-free rate plus, what is this part? Market premium. The difference between the market rate and the risk-free rate is the premium. The extra that you get for taking a risk is the premium. Right now, we will be doing the beta calculation in the last part of this formula presentation, how to estimate beta. But this has a major impact of this on this formula. Right. Now, the entire capital formula is based on a principle of your required return of an investment. Now, when you do an investment, you have expected return. Always you think, okay, I should get this amount as your return. It is the expected return. Required return. Plus a premium for taking a risky investments. Now, the required return is now it's Now take this term. Assume you have money with you. The most easiest investment, or not the easiest, the risk-free investment is available is you can deploy your money to buy government securities. So you will be able to get it. Assume if you have funds, unused funds, then you get the risk-free rate. And it's less than one. Because if you don't take a risk, the return is less. Assume the risk-free rate today, government treasury bill rate is 7%. Now the capital model is based on this theory. Now, if you want to take a risk and earn a higher return, your return must be more than the freely available rate. Therefore, a portion should be added. A percentage should be added to the R, which is this part. If you have opted to buy shares of a company, the return of that shares must always be more than the risk-free rate. So this part is known as the premium, which is the difference between the market rate and the risk-free rate. Now the market rate is average market rate that you can get from having, say, let's take LOLC shares. Now you have decided to buy LOLC shares. So your return must be more than the government rate of gain. How much should be added as the premium? The difference between the market rate and the risk-free rate. Assume your market rate hour is 15 now, which means you are going to add 5% extra to the RF. Now, this is assuming there is no beta. This part should be multiplied by beta. Now assume that you have selected company A's to buy shares of A. A is exposed to a risk, high financial risk. When the beta is more than 1, which means beta is more than 1, means the company is riskier than the average. Now, the company that you are going to invest, ABC BLC, is exposed to risk. Therefore, assume beta is 1.5. What will be the impact? 5% will be multiplied by 1.5, which is 7.5. Your return is how much now? 17.5. Why it is 17.5? Because you have invested your money in a riskier company, and therefore you are expecting a higher return. Now let's think of the opposite. ABGLC, reputable company where the risk level is very less. Beta factor is 0.5, less than the market on average basis. Now, what will be the premium? 5 into 0.5, which is 2.5. Your final answer is going to be now 12.5. 5 is the premium, 5 multiplied by 0.5, 2.5, 2.5 will be added to 10. Your KE cost of equity is only 12.5. Why? ABBAC, in terms of the risk, they are exposed to a lower risk than ABC. So there can be options. The beta can be more than 1, beta can be less than 1, beta can be exactly equal to 1, or beta can be 0. These are the options we have. You don't have more than this. If the beta is more than 1, which means your cost of equity will be very high, because you are going to multiply the premium by a factor which is more than 1. Risk level is more. If the beta factor is less than 1, means the risk level of the company that you are going to invest is less. Therefore, your cost of equity is less. The premium that you are going to add is not exactly equal to premium, it is going to be less than the premium. If the beta is exactly 1, means the risk of the company is exactly equal to the market rates. Then 5 will be multiplied by 5. 5 will be added to 10, 50. If the beta is 0 means no answer from this side. 5 multiplied by 0 is 0. You are left with RF1. No premium will be added if beta is 0. These are the four options you get. Beta is more than 1, less than 1, or equal to 1, or 0. One more. I now using the formula, you will be able to calculate K. Assume Ke is given there in the question, and you are required to calculate the possible value. One variable is missing. Mathematics, not financial management mathematics. Assume you are required to estimate the beta factor of a question. Possible MCQs. Now you ask me, what type of MCQs you get? Yes, a possible MCQ. A possible MCQ can be cost of equity calculation using DVA. A possible MCQ can be cost of equity calculation using capital. A possible MCQ estimate B using capital. Possible. If KE is given, okay, let me write. Now I'm going to start. It's like I'm discussing the MCQ here. Let's take an example. You are required to estimate KE using capital. These are the details. RF is in Rn is 50. Beta is 1.5. What is how much is KE? Quickly, 10 seconds. 13.5. Oh, 70.5. 17.5. 10% plus 15% minus 10 multiplied by 1.5. 5 multiplied by 1.5 is 7.5 plus 10 is 17.5. So the same question in another way, say if KE is given as 17.5, RF of 10 is given, R10 of 15 is given. Question is, how much is beta? Possible. Possible. Beta must be 1.5. So use the formula, unknown variable is beta. You have to. Mathematics, we can do. 17.5 is equal to 10 plus 15 minus 5 e. Take this to the other side. It will be a minus value. 7.5 is equal to 5b. B is equal to 7.5 divided by 5. Not 1.1, 1.5. Same. Right. Okay. And in the previous presentation, we calculated the number of times the expected return, ER of a asset or ER of the portfolio also we estimated. How the return into the probability is equal to the expected return. So expected return only is not adequate for us to take certain decisions. And therefore, what did we do? We calculated the variance and the standard deviation. Now, ER is always expected return is the average one or the mean value bar x bar. ER is equal to the probability into the return. Probability of say 50%, return is say 10%, 50%, ER is 5%, which is the mean value, X bar. X bar or the mean represent the data set, the average value. But in order to take the decision, sometimes the mean value itself is not enough. Remember the bell-shaped curve? The mean is the middle, which is not enough for us to take decisions. You got to know how many points are around this mean. For that only, we calculate the variance and standard deviation. A popular statistic measure of a dispersion, it is the distance from the mean. How far your other data around the mean. Usually 95% are around bell-shaped curve. The standard deviation of 2. So we use this formula. This is the variance, no? The return minus x bar or expected return, which is the deviation. Deviation into power, square deviation multiplied by the probability, and finally total, which is the variance. So we did this number of times. A question, now we can apply this to the projects as well. Now we use the expected return to estimate the, we use expected values to estimate the expected return. Even for projects, this can be applied, the same rule. A project will yield one of 3 NPVs. Those are the probabilities which means either it can give us minus 1,000 or it can give us plus 1,000 or it can give us plus 2,000. Which now in order to have one, you've got to calculate the expected return or expected NPV, whose amounts and probabilities of occurrence are as follows. What is the expected NPV of the project? Very easy. Quickly. Expected NPV, one figure. Now we have 3 figures, but we need one figure, which is the average value. Okay. NPV, probability, and the total. How much? Expected NPV? $900. Please take a note here. 900 is minus 1,000 into 20%, which is minus 200, plus 1,000 into 50%, 500, 2,000 into 30% is 600. 600 plus 500, 1,100 minus 200 is 900. So you have one figure to represent the entire project now. Earlier we had 3 figures. Please take a very small note there after the calculation. The expected NPV of 900 means that the expected NPV of 900 means that on average, comma, on average, comma, the project is expected to create a value of 900, monetary units. Now, in this case, dollars, monetary units, $900. That means, continue, that means if you repeat the project many times, under similar conditions, the average NPV would be around 900. Would be around 900. Right. Now, as explained earlier, the variance is now in this answer, the ER plus 900, which was the needs. So if you repeat the same project for number of times, you will not be able to get 900 each time. It can be around 900. Is the average value? So around 900. To what extent you get data points is the variance, the distribution. The variance can be shown as the range of possible outcomes from the decision is distributed symmetrically around the expected value. The expected value is 900. To what extent you get. Now, let's try to understand further the same expected value with the variance given. A risk-averse investor is faced with 2 competing investment projects. Dispersions of both of whose possible outcomes are symmetrical about their expected values. Which should the investor select? There are 2 now, A and B. Expected net present value, ER, as calculated earlier, both 20,000. The variance is 10,000 and 12,000. Risk-averse investor, you don't want to take a risk, or you want to minimize the risk. Which investment should you select? A or B? Which project should be selected? It's straightforward. You can't select based on the expected values here. The both expected values are equal. Therefore, it should be based on the variance and the standard deviation. The square root of 10 and the square root of 12 is the ST. But you don't need to calculate ST. From the variance itself, you should be able to decide which one you should decide. Take A or B. Higher the variance means what? The points are all lower. Points are all lower compared to the lower variance. So which one you prefer? The lower variance or higher variance? Lower. Someone said higher. Lower. Why then? Expected values are not far away from the mean. If you select the lower one, if you select a project which has a higher variance, which means certain points are very far from the mean, subject to differences. So always you should go for a lower variance or standard deviation. The lower one is therefore project A compared to B 10,000. Even 10,000 is very high variance, but still compared to B, A. Take a note, project A would be selected. Project A would be selected. A would be selected since this offers an equal expected NPV, an equal expected NPV to project B, but with less risk. Right, this is what we studied, point 2 and 3. Read point 2 and 3, where the expected value of project A, what was the expected value of A? 20, and B was also 20. Where the expected value of project A is equal, yes, it was equal to or greater than that of project B. In case if it is greater than even B, or either equal or greater than B, A should be preferred. Even if it is equal, A should be preferred. Reason, A has a lower variance. In case A has a higher expected return anyway, then A is much better. That is what it says. A is either greater or equal. It says where the expected value of project A is equal or greater than that of project B. A should be selected because A's variance is less than B. Point 2. Where the variance of project A, Now the point is not on the expected value, the variance. Where the variance of project A is equal to or smaller than project B. Now, earlier case, it was smaller than project B variance. But even if it is equal, then what? A should be preferred to be if A has a higher expected value. Now, suppose two variances are equal, then what is the criteria? Then go on the expected value basis. When the variances are equal, select the best based on the EV, expected value. In that case, in this example, the expected values are equal, but if the variances are equal, the other one should not be equal for you to take a decision. Then go on the expected values. We studied this form graph before. Systematic versus unsystematic. Systematic risk is the bottom part. Unsystematic is the upper part, which is another term, specific risk. What is the meaning? I explained the meaning of unsystematic risk earlier. What is the definition of an unsystematic risk? Again, possible MCQs. But now we have only 7 days. Unsystematic risk, the risk which can be eliminated by what? Diversification is known as unsystematic. By looking at the graph itself, you have number of investments in this portfolio, number of randomly selected shares. So more items in the portfolio. If the x-axis is for number of items of the portfolio and y-axis is the return, the risk. So the risk can be reduced from this point to this level if you have more items in the portfolio. It is known as diversified portfolio. I used one example, I still remember. Shares of a bank, shares of a hotel, shares of banking industry, shares of hotel industry, shares of another service. So your portfolio is diversified, or shares of a company of another country, you can further diversify. So when you have more items in your portfolio, your unsystematic risk is eliminated. But you can't eliminate one type of a risk. What is that? Systematic, the bottom part. This point to the 0. Unsystematic risk, whether you have one item in your portfolio, whether you have 1,000 items in your portfolio, cannot be eliminated. See, it is the same. Example, market conditions, recession, inflation, those cannot be eliminated from by having number of investments in the portfolio. Usually in theory, we say it's your portfolio should be around between approximately 15 to 20 securities in your portfolio to eliminate your unsystematic risk. By adding further will not reduce it further, it says. Just because when you have more in many number of investments in portfolio, there will be an additional cost. Administration, handling, you have to, there'll be another burden on. So this is, in theory, we say max approximately 15 to 20 items in your portfolio, which is the best. As the size of the portfolio is increased, the level of total risk diminishes, but at a decreasing rates, such that for a portfolio consisting of more than about 15 to 20 securities, adding more securities does little or nothing to reduce the total risk. So it will not add value. Instead, there will be a further burden. Further diversification means that the investor will have to pay higher dealing charges. Of course, your commissions, your handling fees will be more, charges to establish the portfolio, and then we'll have more costs and more work in managing it. So there will be an additional burden. Important points in this graph. Again, x-axis to measure the risk, standard deviation, risk is measured 0, 5, 10, 12, and 15. Expected return on the y-axis, 5%, 10%, 14%. Now read these 2 points, very important one to understand. If we assume both that security returns are symmetrically distributed about their expected value and that the investors are risk averse, then we can completely describe securities by their expected values, or means the standard deviation, and so represent them graphically. Now see, let's think of this A security. If you have purchased A, buying A or C, if you have an option between A and C only, which one you prefer? A. Why? Less risk. Same return, less risk. Same return of 10%, but the risk is less, 12 versus 10. So you select A. Let's compare B and C. You have option to buy either B or C. Same risk level of 12. Obviously, you go for C. B will give you 14 against 10. Same risk level. Each of the 3 points represent the expected return plotted against the riskiness of that return for 3 independent securities. So if the option is between A and C, you should go for A. If the option is between B and C, you should go for B. The summary is given here. All risk-averse investors would prefer investment B to investment C, B to C. B to C, correct. Why? The return is small for the same level of risk, as it has higher expected value for the same level of risk. All risk-averse investors would prefer investment A to investment C, as we decided earlier, A to C. Both has 10%, but less. As it has lower risk for the same level of expected return. 3.2. Both A and B are set to dominate C. The option is between B and C and A and C. Both A and B are set to dominate C. Now, if the choice is between A and B, if the choice is between A and B, then what? It was very easy for you all to decide if the choice was between A and C and B and C. But if the choice is between A and B, what would you do? That depends on your risk appetite, or how much of risk that as a company that you are going to take, your risk appetite. That depends on the company to company. You can't have a tailor-made answer for that. Some companies by nature, they want to take a risk and earn a higher return. Some companies, very conventional companies, they don't take risk. So that depends on the company's risk appetite. Both A and B are set to dominate C. The choice between A and B, however, depends upon the attitude to risk of the investor making the decision. Whether, if say, let's take not a company, individual, still your wish whether you are going to take a risk or not. This is on the shape of the particular investor's utility curve, your own decision. This is what I explained initially. The capital market line defines the relationship between the risk and the return. Any person who is investing money they expect this part, the risk-free return plus a premium for taking the risk, which is basically the base of the CAPM formula. This is the first part of the CAPM and this is the second part of the CAPM formula. The amount of risk premium is dependent on how much the investment is uh, in the portfolio of risky securities. Now, this value depends on, this value is based on the beta factor. The premium will be multiplied by the beta as explained earlier. It can be more than one, then the premium that you would be adding to RF is much higher. If it is less than one, a smaller value. If it is one, the same premium. If it is zero, no premium. Right. Now that for the previous question or the example I did, the beta was given. Beta can also be estimated. Um, this is how we estimate the beta. This part is the captain first part of the formula RF plus Rn minus RF multiplied by beta. The covariance between I and N over the variance of N. Define those now. Let's take Rm, RF, those are basics. Covariance I and M is the covariance of the returns of the security I. Now we talk about security I. M is the market. So the covariance is, now here you don't have two assets. You are estimating the cost of equity of one item. Therefore, covariance is the variance between that particular item and the market. Those are the two variables. Covariance you can't calculate with one. Covariance is always between two. Now here you don't have two assets in the portfolio. You have only one. Therefore, your asset value must be calculated, the covariance must be calculated with the market. So the covariance between your own investment and the market divided by the variance of N market, not your own asset again, the variance of the market. So this part gives you what? The beta. This part gives you the beta calculation. We'll do a question to estimate the beta also. Variance or square of the standard deviation. Answer this question. This is not a beta. Yes, what it says. BPPLC is currently paying a return of 9% on equity investment. 9%. If the return on gilts, these are government treasury bills in the UK, is currently 5.5, and the average return on the market is 10.5. What is the beta of BPPLC, and what does this tell us about the volatility of BPPLC's return compared to those of the market on average? So you are required to calculate the beta, not based on that formula, but based on the capping. First, based on the capping, and we'll do a beta calculation using that formula also later. Estimate the beta factor. How much is beta? Did all get 0.7? KE is 9%. RFP is 5.5. Market rate is 10.5. Answer here is 5. 5B. And when this goes to the other side, this will be 3.5. Is it 3.5? Yeah. 3.5 divided by 5 is 0.7. What if in a question of calculation of KE, the examiner gives you market premium state? Workings. These are the question, details of the question. You are required to calculate KE using capital. Details given RF, say 10%. Beta 1.5 and market premium 10%. These are the details. How much is K? How much is cost of equity? Thank you, sir. Two zero. 10%. Pronounce it now. 10%, 20%, and 25. Three answers. Use calculator. In the question, RM is not given. So do not deduct 10% from the premium. It is wrong. So those who have got 10% answer, they must have deducted 10% from 10% to take the premium. Do not do it. Premium is already given. How much is the RM in this case? RM is how much? 20. 20%. The premium is the difference between RM and RM. This is known as the market premium. Premium is given as 10, which means your RFP is 20%. 20 minus RFP is 10. So do not again deduct 10%. You already deduct. Therefore, you simply need to multiply RFP is 10. MP is given, market premium is given, multiply the premium by 1.5, which is 15, 25 is the answer. So read the question very carefully. MCQs are the most dangerous way of, if it assessments now, that is why it is really sometimes difficult to pass MCQ components of these professional exams. So one word can change your answer. But now, in this case, you are aware of the CAPM, still that word was the issue, the premium. A question. This is to estimate beta based on the formula we studied. Covariance between the IM over the variance of M. That's the formula that we are going to use to estimate the beta. But before that, let me take the attendance. Can I close? Right. Read this 7.4. Was it? What was the previous presentation numbers? 8, right? There's a numbering issue. No? Was it 6? Ah, yes, correct. No, 6. Numbers are correct. 7.4. Yeah, the previous presentation was 6, presentation number 6. Right. Now, what are the details given here? The year-end level of a representative stock exchange index and the price of an ordinary share of ACE PLC were as follows. Price of ACE PLC shares and the market index. So we need the market information and the company's information. That's all, because we are not going to compare with another investment. We are going to compare with market rates. So figures are given. You are required on the basis of the above to calculate beta, ignore dividends throughout. Now see what are the figures given from 1998 to 2008. The market index given 218, 230, 248 index given up to 371, and price of a share from 1998 to 2008 given. Now, can you remember the formula? Formula says, now we are going to estimate the beta, this part. For that, we need the covariance between ACE and the market. We need to calculate the covariance between the ACE and the market. Now, we studied how to calculate covariance in the previous presentation. The very first part of the presentation number 5, how to estimate the covariance. And we need the variance of the market. Those two are required. And finally, you need to divide the covariance by the variance of the market to get the beta factor. So let's take the market figures first, because it is required to calculate the variance of the market return. See the last one, variance sign M is the variance of the market returns. Market indexes are given 1998 to 2000. Let's take I'll take a spreadsheet for this. (1998 to 2008) values. Take the index values as it is. Market index 218, index 230, 248, 250, 282, 297, 288, 290, 320, 356, and 371. Next is based on the index market return. Calculate the return based on the index given. Now, to compare 1998 or to calculate the market return of 1998, we don't have 1997. Therefore, we need to start with 1999. Compare the value 230. Earlier it was 218 divided by 218. Oops. All this time? Here, index. Still no. Now it's fine. Index 28, 1998 to 2008. Index figures as per the question. Those are market figures. Index is for the market. The market return is calculated. How to calculate the market return? The incremental value divided by the previous value. What is the incremental value? Is the difference between 230 and 218 divided by 218. So there is no incremental value in 1998 since we don't have the 1997 answer. I will not take this as a percentage. I will keep the decimals as it is. So those who want to see the formula, see C70 minus C69 over C69, which is 0.055 return. If you're on a spreadsheet, copy this. To get each year's return. In 1 year, it is a negative return. The reason, see, 2003 it was 297, but 2004 it is 288. So it's a negative return.